Hello. The question I've been asked to consider is, are the markets detached from economic reality? Are the markets ahead of where they ought to be, effectively? Before I get into that, just a quick note on valuations, because often those questions precipitate a conversation about valuations. I think that's where the whole question comes from in the first place. So just a very quick note. I think we're in the recovery phase of the business cycle, sort of globally, as well as in the UK and also the US. And during the recovery phase, you expect equities to perform quite strongly, and that's irrespective of the valuation. So if you start off with high valuations during the recovery phase, you'll end the recovery phase with even higher valuations. So I'm not too fixated on valuations at this moment, but if you want to know how I feel about it, then US equity markets look a little bit pricey to me. A little bit, I think it's fair, slightly overvalued, but not so much as to concern me at all. I wouldn't get too bogged down on it. By contrast, European and UK in particular, the valuations there, they're very attractive in the grand scheme of things. And then you've got Japan and Asia Pacific falling somewhere between the two. So moving on from the valuations, because there are some more interesting observations to make in trying to answer the question about the disconnect between the markets and the broader economy. But owing to time constraints, I'm just going to focus on the US and UK markets in particular. So over here on the left is the US economy. You can see that on a sort of year-on-year basis, it's fallen 9% during the second quarter. Yet US equities, in this case, I've used the MSCI USA index, but you could use any, you could use the S&P 500 or whatever your preferred index is. You're going to get slightly different numbers, but the same narrative. So the US stock market is up, and it's up to the how much do we expect the US equity market to gain each year? Maybe 7% is reasonable. You could be optimistic and hope for 8 or 9, but with low inflation, low interest rates, things like that, I think it's fair to expect a sort of lower range from equity markets. But here's the point: at 7%, you've hit your average annual target, and that's in spite of a really deep recession, a global pandemic. So hence the question: is there a disconnect here? How can this be so? Just a few observations. First off, GDP is a reliable lagging indicator. It's subject to some revision, obviously, but as far as in the grand scheme of economic indicators, GDP is one of the more reliable ones, whereas the equity indexes are unreliable leading indicators. So there's a big difference there already. The two are just not the same. So GDP is the value, it's a measure of the value of all goods and services made in a specific period of time, so normally a quarter or a year in the case that I've illustrated, and importantly in a specified bound. So gross domestic product measures what's going on in the domestic economy. So that's, in this instance, within the borders of the United States. Whereas the equity index it simply reflects the market price of companies listed on an exchange. So obviously, some of those companies that are listed on the US exchanges are global in their reach. But there is earnings come from outside of the US as well. And there's another difference as well. It's the current market price, but that reflects estimates of earnings in the future, and in some instances in the past as well. Some of those can be subject to revision. So so there's a big difference, apples and pears. One is what goes on in a specific place in a specific time frame, and the other is what goes on, well, could go on pretty globally, and it could go on next year or the year after, things like that. So there's I expect there to be a disconnect between these two indicators simply because they're not the same thing. Nevertheless, the markets it is true to say that the markets are generally sensitive to economic conditions in real time. So if we just eyeball the developments in the US equity market and put them alongside our best guess for what's happened in the US economy in real time. So in this case, we're using the MSCI US index again. It's on a weekly basis, so hence the straight lines, but it's the story we're looking for. And then the Atlanta Federal Reserve puts together something called GDP Now index, which is a reasonable estimate for what's going on in the US economy at any one point in time. So you can see that the markets anticipated a period of poor economic performance, and then they anticipated a period of recovery. And as far as we know, I mean, we'll know more when the GDP figures are actually released. As far as we know, we did see a big decline and then subsequently a recovery. So the markets have, in this instance, doesn't always happen, but the market so far, and this says nothing of what might happen in the forward period, but the market so far correctly anticipated poor economic performance and then has correctly anticipated a period of economic recovery too. So just going back to this low point and then the subsequent recovery obviously preceded the low point in the economy and the subsequent recovery. But I think what happened was that the markets reassessed their immediate worst case scenario. So if you go back to that period in March, we were afraid that we didn't have enough ventilators. We were afraid that there was a risk that the health service might be overrun. We were afraid that the markets might become dysfunctional. You know, we might get another credit crunch or a sort of 1929 series of events affecting the market, you know, affecting the actual functioning of the market, which would have, which really would have exaggerated a lot of risks that were already out there. We didn't know much about the disease, who was most vulnerable, and what the mortality rates might be. We didn't know what the policy response was going to be in full. We didn't know how long the lockdowns were going to go on for. We didn't know the extent of any stimulus packages that might be brought to bear in terms of supporting the economy. So what we're really talking about here is a reassessment of what the worst case scenario might be. Here was accounting for what was a really horrible worst case scenario, and then as that worst case scenario became less likely, then the markets performed better on the back of that. Just one more observation is that obviously COVID is a public health emergency, it is a medical issue, but there are some skills inside the capital markets, inside the financial services world, that are useful in interrogating the effects that COVID might have, and that is, you know, data analysis. Data analysis is a big part of what goes on in the financial services industry, and there are a great many skilled analysts out there as far as data is concerned. So you know, the markets weren't just flying blind. It happens to be that one of the core skills, one of the things that the markets are really good at, happen to have some transfer in all of this. And then just to go slightly further into this, the green bars represent the performance of the various sectors of the stock market during the different quarters that we've just been through. So Q1, which is the green bars, this was the period of time when the stock market did poorly, so hence the declines. And then the yellow bars are the second quarter, so that incorporates the sort of rapid recovery that we highlighted earlier. The market performed pretty much how we'd expect it to perform during these kinds of circumstances. So those that are economically sensitive, what we call cyclical, so things like energy, which incorporates oil prices, things like that, financials, which incorporate banks, industrials, fairly obvious what they are, but so those were hit hard during that first quarter, and then during the second quarter, as the markets began to anticipate a recovery of some kind, they started to perform poorly. So you can see that energy, for example, that was probably the standout one. Energy did really poorly in the first half and then recovered to some extent. Those that what we call defensives, they performed relatively strongly in the first part of the year. So here's consumer staples, you know, so well, toilet roll would be one, wouldn't it? Quite a high demand for toilet roll. I don't know if you noticed, but they outperformed more sensitive areas and utilities. You know, we all still have to pay our gas and electricity bills and things like that. But notable here is the technology sector, because that outperformed on the way down. It's probably one of the better performing sectors during that period of market turbulence. And then if we fast forward to that period of recovery, was also one of the best performers. So with technology stocks in particular, what you had was they performed reasonably well during the downdraft and then very well during the recovery, which sets them much higher, which sets them on a much better footing as the year has progressed. So you can see that here. So this is the S&P. It's all the information technology stocks inside the S&P 500, so all the FANGs and things, all the companies that you're familiar with. So they didn't fall quite as much as everybody else fell, and then there was a really rapid recovery. At one point this year, they were 40% up compared to where at the start of the year. So that sort of jars, doesn't it? You know, pandemic, Great Recession, all those kind of things. There's one area in the US market that's really performing very strongly. And actually, the US markets, more than others, they have a high proportional weighting in these stocks, so that's why it appeared that the US market was doing so well. But just on that, there's an interesting court case that I just want to reference. So it was in the US, in Pennsylvania, where the county of Butler had taken action against Thomas Wolfe, who was the governor of Pennsylvania, with regard to the stay-at-home orders. Anyway, that went to court and it was found that they were unconstitutional, which is interesting in itself. But there's just a small extract from that court hearing that I think illuminates part of what we're talking about today. So R.W. McDonald and Sons, I don't know anything about it really, but I think it was a sort of family-run DIY type store, and inside the judgment, William Stickman IV had noted that closing R.W. McDonald and Sons did not keep at home a consumer looking to buy a new chair or a lamp. It just sent him to Walmart. So the point is that the policy response to the pandemic was, you know, these stay-at-home orders were one of them. Small businesses were mandated to shut their doors. Larger businesses were allowed to be kept open. And so during the recession, what's happened is that obviously people are going to spend less because of the concerns and the job losses and things like that. So you get aggregate spending down. But what's happened because of the policy response is that it sent what spending that there was to a smaller proportion of the economy. And it just so happens that the proportion of the economy that the spending has been funneled into are also very well represented on the indexes. So, you know, Walmart being a listed company, R.W. McDonald and Sons not being a listed company. So there was a funneling of what spending that there was there. So what's our conclusion? Our conclusion, as far as the US perspective is concerned, is that Wall Street is disconnected from Main Street. We expect that anyway. The two things are not the same. But in this instance, the extent of the disconnect is not unfair, and it's not without reasonable explanation. Now, quickly turning to the British perspective, our economy declined 20-odd% during the second quarter, and the MSCI UK index, or the FTSE All-Share, whatever you want to use, that's down about 20%. So on the face of it, much less of a disconnect between the stock market in the UK and the economic performance. But what's happened since we've got the second quarter is that we've got to look at the monthly figures. The ONS, is where the Office for National Statistics, is one of the few national bodies that provides monthly statistics. We haven't got the real-time look that we have for the US market, but we've got something close-ish. And what we've seen is a really rapid recovery in the UK economy since the low point in April. But that is not reflected by UK stock prices. So you can see there was an increase in the US market here, MSCI US index there, in line with the recovery in the economy. No subsequent increase in the UK stock market, which is not in line with the economy. And I think, growth in Q3 is going to come out spectacularly well. The record, I think the record increase in quarterly growth in the UK at this moment in time is a little over 5%, 5.3, I think, maybe 5.4. But I think, Q3 is going to come in at something like 14%, give or take a percent or two here and there. But you can see that the magnitude of the increase in Q3 growth, not enough to make up for what we've lost, but, record breaking nonetheless. So what explains this this much bigger disconnect between the two in the UK? So rising infections and the behaviorals. So in the US, you've got a trend for infections to be reasonably stable, if not a wee bit down, whereas they're increasing quite at quite a high rate in the UK, just as they are in France and Spain and one or two other places. So there's that, and the UK economy is particularly sensitive to that kind of thing. So that's one thing that might be leading to some pessimism as far as the UK outlook is concerned. And we've got the job losses, which are almost certainly baked into the cake, furlough scheme coming to an end, and the job support scheme being a much less generous support package. So we are going to see increased numbers of unemployed. And then we've got the Brexit issue ahead of us too. But just one other thing about the slightly more technical, slightly more interesting angle as far as disconnects are concerned. Andy Haldane, the chief economist at the Bank of England, was speaking last week at an economic summit, and he concluded that financial markets are detached from economic fundamentals in the UK. So he's talking specifically about the UK. But you can see here on this chart, it's like difficult to interpret, but each of these dots is an economic surprise. These are all good economic surprises, and these are bad economic surprises. So that means that the economic data is either come out ahead of or behind the consensus expectations. So you can see normally when economic data is surprisingly good, you get an increase in the FTSE All-Share Index. And when it's surprisingly bad, you get a decrease. So that explains this line here. So these are good economic surprises, bad economic surprises, good stock market, bad stock market. So the line ought to be sort of, diagonal. That all makes perfect sense. But what's happened for much of this year, I mean, this one really highlights it. This is a really good bit of economic data. It was well ahead of expectations. Not sure specifically what data point this is on this chart, but it might be something to do with the July GDP figures, which were much higher. June, in particular, June figures was much higher than anybody anticipated. But anyway, that good piece of news was accompanied by a fall rather than a rise in the stock market. So there's a big disconnect between the performance of the UK stock market and the performance of the UK economy, perhaps to an unfair extent. So, I mean, like the market not moving in response to either good news or either bad news is the disconnect. I suppose that makes sense when we've got a firm date for Brexit. All eyes are on the end. Well, all eyes are on a single incident at a single point in time. So laser-like focus on Brexit. And so all of this pessimism, all of this uncertainty, all of this concern makes good sense in that narrow focus. But it does open up opportunities for long-term investors. So people, if you've got a genuine multi-year time frame, which we have, then some of what goes on in the short term opens up opportunities. So I get the impression that the UK market or the performance of the UK market is overly pessimistic. And then I'm just going to leave you with some more words from Andy Haldane, because I think these are useful. But in his speech last week, he said it's important the unexpectedly positive progress the economy has made so far this year is not overlooked. The economy has recovered further and faster and has shown far greater robustness and resilience than anyone expected. This positive news has received less attention than it deserves, both on its own terms and because of what it may tell us about the economy's resilience to future shocks. So, we may have a future shock. So note the resilience that we've seen so far. His concern at present is that good news on the economy has been crowded out by fears about the future. And I agree. And I think there are opportunities in that disconnect. So yes, disconnect between markets and the economy is normal. The disconnect in the US is reasonably well explained. The disconnect in the UK is less well explained. The opportunities, therefore, I think, are in the UK. And I'll leave it there. Thank you.